With great pleasure, let me now welcome a very special guest on ET Now. See, she needs no introduction whatsoever. She clearly has been knighted as one of the most powerful bankers, not only in India, but Asia. Shikha Sharma of Axis Bank. Thank you so much for joining us. We've caught you in the middle of your banking hours, so thank you for accommodating this interview request.
Thank you, Nikunj. Happy to be here.
Before we talk about specifics of Axis Bank, I just want to understand the big picture from you. Let me sketch the big picture and then you can paint in the colors. We are growing at 7.5%, but it does not feel like we are growing at 7.5%. I can see the recovery, but I cannot smell the recovery.
Yeah, so I think we have to look at it in a wider context. If we look at the globe, growth is a challenge in most parts of the world, and we live in such a connected world that to expect to be isolated is impractical. So actually, we are facing some headwinds coming from what's happening globally, whether it's the slowdown in China or what's happening in Europe. Within that context, I think we should be pretty happy with the 7.5% growth. To your question on why doesn't feel like 7.5% growth, because see, for a lot of people, it's the top line rupee number that they care about. And with inflation at 6-7%, when you had growth at 6.5% and you had another top up of 6-7% inflation on it, it felt like 13.5-14% growth. But now with growth at 7.5% and WPI inflation being virtually zero, it feels like 7.5% growth in the top line. So that's why it feels like it's slower. But if you look at it in real GDP terms, I think people have tried to analyze the numbers all kinds of ways and have convinced themselves that yes, the 7.5% number is correct. It's flat to negative WPI inflation, which doesn't give that sense of momentum on the ground.
How far are we away from this? Because the scenario which you painted, I think, is the ideal scenario,
right.
But nothing moves in the straight line.
Right.
So how far are we from a real pickup?
So I think the markets and entrepreneurs always invest ahead of the curve. So they're not going to wait for growth to happen. They would probably wait for interest rates to come down. They would probably wait for capacity utilizations to go up a little bit. I think it's very hard to predict the future. So I don't want to put an exact date to it, but I think investment will come soon, especially given what the government itself is doing in terms of kick-starting investment in public infrastructure, whether it's roads, railways, irrigation, ports. I think all of that, defense, the government's doing its bit in terms of putting infrastructure on the ground. And I particularly liked a lot of the initiatives that were mentioned in this budget around the rural economy. The steps that the government wants to take around the rural economy are things that we have thought about in this country for a long time. Simple things like getting roads to the villages so that they have access to markets, investing back in irrigation and water bodies, providing access to markets through digital platforms. I think those are all very important initiatives and they can transform our agriculture. And if we can look at what more can be done to get agricultural productivity up, I think I feel optimistic about the future. As I said, tough to predict exactly when the investment cycle will come back, but I definitely think India is very well positioned.
Markets are obsessed with NPAs. They feel that NPA is a huge problem and the problem is here to stay. So what is your understanding of the current credit cycle from the previous credit cycle? It's not that for the first time NPAs have gone to 10% in PSU banks. They've happened in the past. But what's the big difference between the last cycle and now?
So the big difference, Nikunj, is that in the past cycle, whenever we have had NPAs, they are typically as a result of slower growth. Depending upon which cycle you're talking about, it could be global headwinds. It could have been the financial crisis of 2008, 2009. But the environment is fundamentally, growth slows down because of some parameter. And as growth slows down, inflation comes down as well and interest rates come down as well. So what happens is it does two things. When interest rates come down, interest burden for companies comes down. Interest as a proportion of their gross margins becomes lower, and therefore their ability to service debt becomes better. And for banks, as interest rates come down, they are able to get some gains on treasury, and that helps to offset some of the credit cost. In my banking career of over 3 decades, this is the first time we are experiencing a situation where growth has come off, but interest rates have held high. So you're not getting any of the offsetting benefits of a lower interest cycle in this particular credit cycle, and I think that's the genesis of one.
Just a coincidence, we're talking on a day which is 16th of May, and 2 years ago the mandate changed, the government changed. So 2 years into Modi government, let's make a quick checklist.
I think that it was the first time after a decade that a new government came in who had majority in the Lok Sabha, and I think everybody was very excited about it, and therefore expectations were huge, and I would say were irrational, because if you take a large complex country like India with a host of problems, nobody can wave a magic wand and change things, and we are operating in the global environment that we are operating in. So I think anything that we say about what has happened in the last 2 years must bear that context in mind and see in that context what all has happened. And if you look at it in that context, I think a lot has happened. India's image in the world has changed. I think we've invested more in external relationships than ever before, and while we may have views on it, we have to remember that we live in a connected world. So developing relationships with the world is important, and developing relationships with an economic agenda is even more important. You look at what other large countries are doing. They are developing relationships with an objective and a goal for economic growth, and I think that's what we have done in a focused manner, and I think it's very important for the long-term growth of this country. Governance and transparency. If you don't have governance and transparency, you don't have right allocation of capital, and for a capital scarce economy, that's a very important thing to put in place. I think the government has taken n number of initiatives around getting better transparency and governance, whether it's trying to make doing business simple, whether it's around auctions to provide transparency. I think those are fundamental long-term transformational things which the country needs. And yet at the same time, I think some of the short-term initiatives that have been taken around kickstarting spending, focusing on doing the right things for the rural economy, financial inclusion, Jan Dhan, it's such a dramatic success, right? It's broken all the record books. Let's look at all the positives that have done instead of complaining about what should have happened or didn't happen. There's always stuff to do, but I think a lot has happened already.
I'm a diehard optimistic, and I know even you are. So let's look at it this way: that the economy is healing, and the trajectory is growing in the right direction. But the communication which came from Axis Bank along with their Q4 numbers was that there's a concept of Watchlist. This is what the book is. This is how the book looks like. So what prompted Axis Bank to come out with this Watchlist concept? Are you addressing all the doubters, and are you preparing the bank for a better surprise ahead?
So there's been so much of discussion around asset quality of banks over the last few years, and in our second quarter results, there was a large account which slipped into NPA, and we had to dip into contingent provisions to provide for it. We had, in most of our discussions with investors and the market community, been fairly open, saying that in our power portfolio we had two sources of stress. We had the gas-based power projects, and we had one large stranded project in Bihar, and that at some point, while it was a performing asset, it might slip into NPA, and we would have to dip into contingent provisions to provide for it. So we thought we had communicated that, but when we did announce it, it was a surprise to the market, and people thought they hadn't understood it well. And then after that, the RBI asset quality review came, where there were some changes in the way RBI was approaching recognition of NPLs, and that caused consternation as well. So people started wondering, what's the asset quality problem? And we thought that instead of having people imagine, have a guess at it, it's better that we go out and share with the street that as far as asset quality review is concerned, yes, we've provided for everything that RBI wanted us to provide for, but given the environment, given that some of these problems are going to take time to play out, whether it is coming from slow growth, high interest rate kind of phenomena, or it's coming from some of the projects which were funded in a particular regime, and coal mines got cancelled, for instance, or there were delays in approvals for some of the other projects which lengthened project implementation and therefore changed economics. Some of those factors have impacted stress levels in the bank. And so we thought it's much better that we do an exercise internally of assessing which of our lending is looking like it could become under stress in the future, and give a guidance to the market to that extent. And so we looked at, the all kinds of things that get floated around: restructured assets, highly leveraged companies, specific sectors, SMA record. We looked at all of that data, and we looked at that data and looked at what percentage of our book might have potential stress, and we thought it's best to share it with the market.
But the number may not spill over 23,000 crore, irrespective of, something goes wrong in the global economy. If there's a Lehman event, of course, you can't forecast that. But as of now, looking at your assumptions of macros, earnings, and your interaction with corporate, this is the high watermark number.
So I want to explain what we have tried to do over here. So we've looked at our book and we've said that there is a book which is business as usual. There is a part of the book which has been impacted by, these factors that we mentioned earlier. And that is the part of the book which is likely to show elevated levels of stress. The rest of the book will continue to have normal levels of stress, but this part of the book is likely to have elevated levels of stress. And when we looked at the size of that book, then it's about 23,000 of outstanding loans at the moment. We are not saying all of this is going to slip into NPA. Yes. Our current guidance is that maybe around 60% could slip into NPA, but we would have to calibrate that number depending upon how the environment pans out.
Now, what is growing for Axis Bank and what has worked like a charm for you is your retail book.
Right.
On a large base, it is growing at 40%. Now, mathematically, it's impossible to grow at such a large base at such a run rate. So, will it be difficult for your retail book to grow at historical run rates?
So, first of all, I should correct you, Nikunj, it's not growing at 40% anymore. It is now 40% of our book,
of course.
And it grew at about 25% last year. So, our whole focus on consumer lending started around 2010, and we had gone through the cycle of 2008-9 where, a lot of banks had bad experience with retail lending, and Axis Bank in particular did. So, what we did then was set our house in order as far as credit management, collections is concerned, and then chose to grow that book by cross-selling primarily to existing customers of the bank. So, when we started out, growth rates used to be like 40% because we were very small, but as the book has grown larger, for the last 2 years we have been growing at around 25%. Given the fact that we still have a lot of headroom in terms of selling to existing customers of the bank on the deposit side, we believe that we should be able to sustain a growth rate of 25% in the near term at least.
But will the total composition of the book change? Let's say it's a split between 40 and 60 and 40. 60 corporate, 40 is retail right now. Do you see that changing in 3 years? Could it be 50-50 or 45-55? Is that where eventually you're headed?
So, we had two purposes when we started this journey towards consumer lending. One was diversification of the book, that as you grow the book, you don't want risk concentration. From that perspective, I think even 40-60 is a good number. It's a much more diversified book than what we started out in 2009. From here, it's really going to be around where are opportunities and where do we find profitable growth. If you ask me to take my best guess of what might happen over the next 3 years, I think retail will still continue to grow faster than the rest of the book. Whether that will land us at 45 or 50, I wouldn't want to hazard a great guess, but I would suspect it will be over 40%.
But will it be difficult for you to now grow your corporate book? And let me just finish my question here. When I say difficult to grow, because banks have become conservative in lending. They want to choose whom they want to lend to. Consortium lending is no longer that popular right now. And if I was looking at your commentary along with your Q4 numbers, nearly 70% of your lending has gone to A corporates. Now everybody is targeting those A corporates. Everybody wants to associate with those A corporates, and there are only limited A corporates.
Right.
So how will the regime change?
Yeah. So as part of our risk policy, yes, we have been focusing on how do we manage risk better and how do we take risk where we can afford to manage it. And given that there has been stress in the system, yes, we've been focusing on lending more to the A and above rated corporates. And given the market dynamics, we've not found it difficult to get that growth. So, if you look at last year, our corporate book has grown more than 20%, despite the fact that A and above rated was more than 75% of the new lending. So, so I think there will be opportunities for banks which are well capitalized, which have the ability to service corporate customers on a full service basis. So, as a bank today, we have the ability to lend, to do channel finance, to do transaction banking, cash management. We have the ability to do debt capital markets, equity capital markets, M&A. So, we are today a full service house as far as corporates are concerned. And that means that we get early into conversations with corporates and are able to understand their needs and help them fund those. That does give us the ability to grow faster than the rest of the system, even while tightening some of our underwriting standards. So, we are not really worried about growth.
It was a conscious move by the bank to not to venture into the insurance business.
Right.
But looking at the way how insurance companies are now, piping themselves for IPO, the kind of valuations they're commanding, any regrets?
No, I think if we look at the companies who are likely to get IPOs today and get good valuations, I think those are companies that started out in 2000. So, 10 years down the line, to try and compete in a business which has been well established by others, we thought was not the best use of capital for the bank, and that we would find other opportunities for growth where we could deploy capital more effectively. And we believe that still stands true.
So, as an outsider, what is your view on the way how the insurance sector is moving? First, you were an insider, and now I want an outsider's view.
So, I think the insurance sector in India, we still have a lot of underpenetration of products, whether it's life insurance or it's general insurance or it's health insurance. I would think in general insurance and health insurance, the level of penetration is even lower. So, I think there is therefore a lot of opportunity for growth. As India modernizes its pension system, I think there's going to be a lot of scope for growth in pensions, which are being provided by a host of providers, but life insurance companies are one of those. So, I think there is potential for growth in all those segments of insurance. There's been a lot of regulatory changes, and I think the sector has had to cope with some of those changes. Hopefully, we'll see more stability going forward, and therefore we will see growth come back on a more stable platform.
As market commentators, we tend to track your numbers with a magnifying glass, and literally with a magnifying glass. Whereas, as the manager, you would not look at numbers, you would be chasing something else. Markets and shareholders, they love to chase profits, but I'm sure you're chasing market share, you're chasing growth. So what exactly are you chasing at Axis Bank? Your DNA is to be aggressive, but what are you chasing aggressively?
So, my DNA is not to be aggressive. Let me clarify that.
25% retail growth, that's aggression.
That's ambition, and that is ambition in a context where we believe that opportunity lay in a manner which was right for shareholders and customers. So, what are we chasing? I think for an institution, and we are building an institution which wants to be amongst the best in the world, for an institution to be viable in the long term, what's totally important is that we serve our customers well, and we keep our customers right in the center of any strategic decision that we take. That's something you've probably heard me say in 2009 when I joined the bank, in 2000 when I was in ICICI Life as well. But certainly as far as Axis Bank is concerned, we are very focused on saying how do we serve our customers well. How do we make sure that we have the right products that we offer them, whether they are manufactured by the bank or they are distributed from a partner that we choose to tie up with. So, that's the core thing that we chase, trust, satisfaction of our customers, depth of relationship with our customers, and then I think the two other things which are very critical is we are a regulated industry, and it's important that we maintain our reputation from being well governed and well regulated, and we need capital to grow. So, it's very important that shareholders should trust us with the investments they make. So, we have to chase growth profitably. So, we want to serve customers, we want to be a respected institution, and we want to chase profitable growth, so that it's something that we can scale. Acquiring customers while making a loss, we think might be a short-term strategy, but doesn't work in terms of long-term institutional building.
So these are the metrics. These are the key metrics on which you judge yourself.
Right.
Just to understand the messaging from Reserve Bank of India, and the messaging from Reserve Bank of India for the longest time has been that Indian banks are making too much money. The spreads are too big, and they should come down. so far banks have done a great job of maintaining those NIMs, and that's really a phenomenon with the private sector banks. Is there a threat to the NIMs?
So I think we have to look at it from a perspective of for growth, banks will need capital, right? So we have to deliver the kind of target return on capital that markets will expect if they are going to give capital to the business. And in rupee terms, let's face it, shareholders want a return of 16 to 18%. So you can get that 16 to 18% through NIMs, or you can get them through fees. In the Indian context, which is largely a loan-led market and a lot less activity by way of bonds or by way of services that consumers consume, plus a lot of regulation on levels of fees, the percentage of fee income for Indian banks is much lower than global counterparts. So much of the earning for Indian banks comes from NIMs. I think we should watch the ROE numbers and see, are the ROE numbers fair and are the ROE numbers sustainable, both from a perspective of delivering right products to customers but attracting enough capital for growth. I think we have to see how things evolve, but if NIMs are to come down, then there have to be other opportunities for fee growth for banks to remain viable.
When do you think your NIMs, it may not happen this year surely, it may not happen FY18, but eventually do you think your return ratios would be nearing 20%?
ROE?
Yes.
So as far as ROE is concerned, typically when we raise capital and our levels of tier 1 are high, our ROE tends to get depressed because we have excess capital. Currently our tier 1 ratio is over 12.5%. So we do have quite a bit of excess capital. As we leverage up that capital and we keep our other operational metrics tight, we should be heading back to an ROE of 20%.
Couple of last questions, and new faces on the board, government nominee out, what will that change?
So, I think Suti has been incredibly progressive in agreeing to change the articles of association for the bank. As you know, Axis was set up by UTI more than 20 years ago, and at that time UTI was the sole owner and had the right to appoint the chairman and have 3 other nominees on the board. Now over a period of time the shareholding structure has changed, and I think the government and Suti have been very progressive in saying that in line with the changing shareholding structure, the board composition should change as well. So Suti has recently agreed to dilute nomination rights. So Suti will have 1 nominee director, and LIC, which is the other large shareholder of the bank, will have 1 nominee director, and the bank gets to elect its own chairman. So not really new faces on the board, but as a result of this, Axis now has its own independent chairman elected by the board, and we really feel privileged that the government has put this vote of trust in the bank and allowed the bank to move to a more modern governance structure aligned with the shareholding pattern of the bank. Dr. Mishra is a very, very eminent bureaucrat who has got huge credibility in government circles as well as with regulators, and we feel very delighted that he will continue as the chairman of the board.
But Axis board was pretty much independent, so on paper I guess nothing changes. Technically things change, but on paper will anything change?
So in actual operations, I think I've been very lucky to be a CEO who reports to a board which has been very eminent, very professional and very independent. But in terms of the governance structure, I think for the long term it's important to have the right governance structure, and in that context I think the change is a significant change.
Would you as a banker vote for extension of RBI governor? Can India afford a new governor right now?
I think we are very lucky to have Dr. Rajan as a governor. He has led us through a difficult period very well, and he's lent credibility to the country, but that decision is not ours to take, and I'm sure wiser, more experienced people will do what's right for the country.
But as a banker, would you back for his extension given an option? If I'm asking you this question on a public forum.
I think he's been a great governor.
I saw a lovely movie a couple of years ago, Wall Street, and Gordon Gekko said that every banker on Wall Street has a number. So is a number which you're chasing personally or for Axis Bank?
No, I don't chase numbers. I chase stories
And customer satisfaction.
and customers. And that's the biggest story. So one of the stories, some of the goals that we are trying to chase inside Axis Bank, other than the numbers, are 1 million livelihoods that we want to help support through Axis Foundation, 1 million trees that we want to have planted through some of our green initiatives, and 1 million stories of happy customers. So that's what would delight me.
There's another number which markets measure banks on, and that's the market cap in billions of dollars.
Right.
That's not the number you're chasing.
That's not the number I chase. I look at it occasionally, but I'm not chasing it.
Really appreciate your time. I'm so glad you could join us, and you could join us in the middle of your banking hours.
No, thank you so much, Nikunj.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.